I'm your host, Michael Shermer. Before I introduce today's guest, our sponsor is the Great Courses Plus. It's an app that's on your phone. You just touch the phone and it opens right up to a course. Apropos my guest today, this particular course I'm going to tell you about is the economic history of the world since 1400. Well, that's pretty much everything in terms of modern economic theory. This is 48 lectures. Here's the beauty of the Great Courses Plus app. You subscribe for the year. If you do it through this show, you get a free trial and 20% off. So that saves you about $30 a year. And you do that through thegreatcoursesplus.com/Shermer. That's thegreatcoursesplus.com/Shermer to get you the free trial and 20% discount. And you can access courses like this. 48 lectures, each is 30 minutes long. How the Black Death reshaped town and field. The manorial society in medieval Europe. Marco Polo, China and the Silk Road trade, European plantation labor problem, British coal, coke, and a new age of iron, and on and on. This is just up into the 20s and 30s. Adam Smith's argument for free trade, World War I and industrial powers collide, all the way up to the modern world of China, half the world left behind in poverty, Gorbachev and the Soviet decline, on and on. The beauty of the Great Courses Plus app is that you can skip around. You can listen to any one or all or none of these lectures, try a different course, a whole bunch on finances and economics. So that's thegreatcoursesplus.com/Shermer to get the free trial and discount. My guest today, apropos of this, is Alex Green. Alexander Green is the author of The Gone Fishing Portfolio. Get wise, get wealthy, and get on with your life. I've known Alex for many years, and he's not my personal financial advisor. I don't have one. I just do it myself, which is what he tells you to do in this book. So that's why I recommend it. I call it the Gone Cycling Portfolio. That is, the point is to make some investments and then just leave them alone. They will accumulate. And in the stock market, like an index fund, for example, you will make on average 10% a year. Every year, it'll go up and down, but if you leave it in there for 20 to 30 years, you will make money. Anyway, we discussed that, how money in the stock market works, how the stock market works, why we need a stock market, what's the whole point of that, the origins of money, why we should make any money at all, why money matters to your life, how to make it work for you. We discussed the difference between individual stocks versus index funds and mutual funds and the different kinds of those that there are. We talk about the millionaire next door. That is to say, how most millionaires live. You would never even know that they're millionaires, and that's one reason that they got to be millionaires. We talk about the survivor bias. That is, we only hear about the Steve Jobs and Bill Gates and Jeff Bezos of the world. What about all the other people that failed? So one reason we have a stock market is because most people fail. And so you have to have some kind of system in place to carry debt for these major corporations, or else we wouldn't end up with iPhones that cost hundreds of dollars. They'd cost tens of thousands of dollars if you didn't have a big company able to make so many of them. Anyway, we talk about Social Security and to what extent you should count on that. Talk about the difference between an IRA, a SEP IRA, a Roth IRA, and a 401k, and what those mean. We talk about the relationship of risk and reward, difference between savings and spending. Talk about free market capitalism. And then we kind of pull out and look at things like the shortcomings that a lot of people just bad luck. They just are just down on their luck, or they don't have the intellectual or physical capability. So we need a social safety net. So we are in agreement on that as our most modern thinkers today. So we talk about that and then go from there to UBI. Do we need a universal basic income? What that could mean. And then we talk about the role of luck and contingency and how lives turn out. As you know, one of my favorite topics because it's important and interesting. And so with that, I give you Alexander Green. Alex Green, nice to see you. Thanks for coming on the show.
Yeah, thanks for having me, Michael.
I think our listeners are going to kind of wonder what's the link here between my usual science, tech, history, philosophy. Well, in fact, I think economics, financial matters is every bit as important, and certainly data-driven. I mean, if anybody has data, it's people like you, financial advisors,
absolutely.
Or if you want data, go to the Bureau of Labor Statistics. Oh my God, it's just a mind-blowing, eye-blurring, massive data. So,
right. And plus, scientists and technicians and mathematicians have to manage their investments too, so they got to be interested.
That's right. Yeah, yeah. So your book, of course, I'll give it a proper introduction in the intro to you. The Gone Fishing Portfolio, as you know, I call it the Gone Cycling Portfolio. Make your investments and then
Right.
go do something else instead of trying to beat the
Exactly.
market and all that stuff. But before we get into all that, just give us some kind of a general background of where you grew up, how you got interested in this subject, and how you came to write this book, and where you are today.
Okay. Um, well, I grew up in Stanton, Virginia. I always say that grew up in a Norman Rockwell painting, a little beautiful town of Stanton in the middle of the Shenandoah Valley. Went to school at Furman University, where I majored in business and psychology, which I didn't know at the time was perfect for someone's interested in the stock market because it's the combination of business and psychology that an investor needs to understand. Um, I kind of knocked around making a living with a real estate license for about 5 years. And then in 1985, I took a position as a stockbroker at a firm in Winter Park, Florida called International Assets that specialized in investing in equities in global markets. And was a broker and a research analyst. And the firm didn't have anybody to write the research report, so I took on that responsibility. I wrote all the research reports and client communications. And I stayed in the business for about 16 years, and I reached a point where I was financially independent, and I decided to take a full-time job writing about the stock market for Agora Publishing. I'm the chief investment strategist of the Oxford Club today, and so I write an investment newsletter and various e-letters talking about the markets and interest rates and currencies and commodities and stocks and bonds and so forth. And that keeps me out of trouble
Yes, well,
most of the time.
I'll have your full bio here with your various financial newsletters and so on. But maybe a good place to dive into this is where you open your book with the Securities and Exchange Commission's report on the financial literacy of Americans. Just to read a few excerpts from this report. When asked the primary benefit of portfolio diversification, respondents were given three choices: A, risk reduction; B, increased returns; or C, reduced tax liabilities. Only 56% knew the answer was A, that is, risk reduction, assuming that they even understood the question, depending on who you're asking. When asked whether a young
Correct.
investor willing to take moderate risk for above average growth should invest in A, treasury bills; B, money market funds; or C, balanced stock funds, 63% of respondents chose the wrong answer. And even 49% of fund owners didn't know the correct answer was C, balanced stock funds. And then your last point here, when asked whether a traditional IRA, a 401k, or a Roth IRA offers withdrawals that are tax exempt, only 44% knew the correct answer was a Roth. I didn't know that either until my accountant kind of walked me through where I was supposed to put my money at the end of the year. uh,
Right. Right.
and of course, there's those studies that show that, most people have next to nothing when they retire. And that's why a lot of large corporations and universities and government agencies do it for you. They do that
Right.
that libertarian paternalism, that opt out choice architecture, where you will be getting this following retirement portfolio unless you opt out and take this riskier one or whatever. So all this is kind of
Right. The
indicating
nudge.
that we're pretty ignorant when it comes to these important issues.
Right. Well, you raise an important point here, Michael, because it's really a shame, the not just the financial illiteracy, but the basic financial literacy is not taught in every public high school in America. I mean, everyone's going to have to deal with a checking and savings account and eventually a 401k but people graduate from high school and they don't understand what a Roth is, or a 401k, or an adjustable rate mortgage, or why we even have a stock market. So they don't have the most basic understanding of markets. And then oftentimes they go off to college and they're taught that we live under this unfortunate economic system called capitalism, which is based on greed and selfishness and exploitation. And people they venture out into the world and they get a 19% credit card and don't know what to do with their savings, don't know how to budget or how to invest. And by the time they figure it out, they've lost a lot of valuable years that their money could be compounding. Even small amounts of money saved early on can turn into a vast amount as it compounds over the years. So I've kind of made it my mission to do what I can to bring people up to speed on the basics of saving and investing. And of course, the point of the book is that ordinary people who don't have a great deal of sophistication are perfectly capable of managing their own money effectively and outperforming the vast majority of professional money managers. I know that seems astounding to some people, but it's a well-known fact that most money managers cannot beat an unmanaged benchmark. Each year, three-quarters of them fail. Over periods of a decade or more, 9 out of 10 of them fail. And the ones that beat the market for the last decade may not beat the market for the next decade. So you can manage your money yourself. You can outperform the vast majority of professional money managers. You can pay nothing in sales charges and fees and brokerage commissions, and you can do it in 20 minutes a year or less, and have the pleasure of managing your money yourself and knowing it's based on a system that's so sophisticated that it won the Nobel Prize in economics in 1990. Went to Harold Markowitz. So that's the point of the book is you can manage your money yourself very effectively, very simply, at very little cost.
Yeah, in other words, don't pay somebody to do it, but do it yourself. It's not rocket science, but you do have to know a few things, and that's all outlined in the book. But the point of this conversation, not just to say you got to buy Alex's book. I mean, anybody can do this with this sort of basic knowledge. I love that the line in your book about what was it? Where are the clients' yachts? How come the hedge fund managers have yachts,
Oh,
but the clients don't?
yeah, that's the story of Fred Schwed wrote it. The book was titled "Where Are the Customers' Yachts." He was new to a brokerage firm. They took him down to the harbor and they said, "Here's the president's yacht, and here's the CEO's yacht, and here's the chairman's yacht." And being very naive, he said, "But where are the customers' yachts?" Of course, the answer is where indeed, because even though the people at Merrill Lynch and Morgan Stanley and Goldman Sachs are smart people, and they're trying to help you achieve their goals, there's a bit of a mixed motive there because they also are interested in converting a substantial portion of the client's assets into the firm's assets. It's just how the business works. I mean, I was in the industry, and when the people in the industry talk about their production, they're talking about nothing about the client's returns. They're talking about how much did you generate in fees and commissions for the firm this month. That's your production. That's your goal. So yes, you want to raise those fees by gathering assets and increasing someone's accounts, but that's not done at a low cost. And one of the things I point out in the book is we're used to thinking that you get what you pay for. That if you saw the best accountant or you went to the best heart surgeon, you're gonna get what you pay for. But that's simply not the case on Wall Street. That one of the reasons Warren Buffett says most investors would be better off in an index fund is because he's saying that most professional money managers are not going to get the job done, and you're going to pay a lot in fees, often hidden fees that are taken out of the value of the fund. You never even see what you're paying. And the idea is to keep more of that money for yourself, which you can do if you manage your money yourself. But as you point out, you do have to know something of the fundamentals, and that's what I try to address in the book.
Yeah, so in other words, they're getting paid whether you make money or lose money. Either way, they get their commission.
Absolutely. Absolutely. See, sometimes they'll say, well, look, we only get paid more if your account is worth more, and that's true, but they're also getting paid if your account is worth less. Uh, you can have a transaction-based relationship where you're paying on each trade, or you can have what they call a fiduciary relationship where you have your advisor gets paid a fee, and that fee is based on the value of the account. So if the account's worth more, obviously they get more in fees. But do you want to pay more in fees when you could be keeping all those fees for yourself and doing just as well, if not better, by managing your money yourself?
Remember one of the first credit cards I got, and then it was a Visa, and then I got a American Express, and each month I'd get the bill, and it would say, "Here's the minimum payment," and I thought, "Oh boy, that's pretty small. That's easy. Now let's see how long it'll take me to pay off what I currently owe at that minimum amount." It's like, oh, I see. Okay, I can't ever let
Yeah.
them, do this to me because that's where they make just huge amounts of money. If you had if
Well,
you
right. If
spent a
you,
couple $1,000 and then you paid the $62.37 a month, it would take you, years to pay it off. That's just that month.
right. Yeah. You buy something on sale, and after all the interest charges from the credit card company, you might as well have paid more than full retail because you're going to pay it coming or going.
Yeah. Let's start at the super basics. What is money?
Money is a wonderful invention because you can imagine back in the day, many hundreds of years ago, thousands of years ago, people bartered, and that's a tough thing to do because maybe you want my cows, but I don't want your wheat, or you want my wife to help sew your quilt, but we don't need your chickens or whatever. So it's very difficult to barter, and so money was a wonderful invention, and for the longest time money had to have intrinsic value. You had to have gold coins, silver coins, something that that you knew it was a value. So paper money was an amazing innovation. Yeah, I can only imagine the first guy who said, "Now let me see. You're going to take my cows and you're going to give me this money, this paper here." um, of course, most paper money originally was simply a note that you owed the money, you owed a value of this. But money has changed, and now, of course, most money is electronic. You use a debit card or a credit card, or you wire money, transfer, electronic bill pay. People don't even touch the currency at all. And then, of course, we've now gone to digital currencies, cryptocurrencies, which are quite the innovation. I mean, obviously, the blockchain is a startling development and has all sorts of implications for the future. And digital currencies are interesting, highly speculative at this point. I'll also say because there's not a whole lot you can do with your bitcoins if you have them, but they've certainly been an excellent speculative asset. So money's always evolving and changing. It's another form of technology. So a lot of things happening in the financial markets right now.
We often hear this term fiat money because there's no gold backing it. It's just the government says it's valuable, and our government is big and trustworthy and stable, and the economy's growing, so everybody agrees that it's valuable. It's almost like a useful fiction.
Well, it is. Of course, Nixon closed the gold window about a half a century ago, and until that time, you could exchange your currency for gold. But he ended that, and so some people, hard money types, as they say, will say that uh, fiat currency really is ripe for exploitation because they can create more money. They can obviously, the more money the government creates, the less money less existing money is worth through inflation. Uh, uh, so so gold bugs are the ones who say that we should go back to the gold standard. But the problem with that, as we saw in the Depression, is that there's very little that the government can do if they don't have the wherewithal to meet financial emergencies by providing liquidity. So some people like cryptocurrencies are strictly limited, not set by the government. Um, but you could say what you could say about Bitcoin, you could say about the other cryptocurrencies as well. The Bitcoin's limited to 21 million, but other cryptocurrencies are also limited. So you have a limitless number of limited currencies. So the idea that they're limited in quantity and decentralized on the blockchain and not controlled by government doesn't provide a perfect solution because you can just keep creating more cryptocurrencies. And Bitcoin is so valuable in part because it's the first. Um, but Motorola had the first cell phone, and then they faded, and BlackBerry had the dominant smartphone, and then they didn't, and then Netscape had the browser, and AOL was online access, and so the first is not always the best. When the automobile came out, people quickly realized that this is the future. The horse and buggy are going to fade away, and people are going to switch to cars. And then within just a few years, there were 100 automakers in the U.S. And then very quickly, there were just three: Ford, Chrysler, and GM. So you could have seen that cars were the future and invested heavily in automobiles, and 97 out of the 100 car companies you could have invested in would have disappeared. So I think the same is true of cryptocurrencies today. We're very early in that game.
Yeah, interesting. Yeah, this is one of my rebuttals to people that say they're worried about social media, so the government should break up the big tech companies and so on. I don't know. It's like the history of business. Very few companies last very long at all. And, Facebook and Twitter, they're, Google, Apple, they're big now, but, they're likely to go the way of that everybody else has gone. Either they'll go out of business, but more likely they'll be acquired or they'll just stabilize. Somebody else
Right.
will beat them, or there'll be something new that just completely different. Then they just lose that kind of power and influence.
Yeah, even Jeff Bezos says that about Amazon. He says we're dominant now, but it's just a matter of time before somebody comes along with something newer, better, and dominates us. He realizes that's really the history of business. And one of the reasons that you diversify a portfolio, if you own a business, it's risky to competition. You get there are all sorts of business risks, political risks, uh, and owning a diversified portfolio of stocks is far less risky, which is part of the questions you read there initially. Obviously, owning 5 businesses is less risky than owning one business, and owning 50 businesses is less risky than owning five. And that's the idea behind indexing: is you've got your risk spread among a number of different industries and companies, and all those companies hopefully will prosper, but we know they won't. And so, since you can't know in advance which ones will prosper and by how much, which will be the best performing stocks, the idea behind indexing is you essentially own the whole market, and that way you own all the winners. And even though a lot of companies will languish, some will go out of business, the gains on the companies that do well will more than offset those many more that give mediocre or even poor returns.
I was going to ask you about cryptocurrency later, but since we've been on it, just in English, if you can explain how Bitcoin or cryptocurrency works, and is it a hedge against the constant apocalyptic fear that the government's going to go out of business or fail? And previously, the gold bugs always said, well, you got to have your gold and your guns up in your cabin in Idaho, in case the end comes. Well, let's set that aside. But is cryptocurrency something like a hedge against government inflation or anything like that?
Well, it's too early to say it's a hedge. Let me back up and say so. Cryptocurrencies. The benefits of cryptocurrency is strictly limited issuance, so it can't, unlike fiat currencies where the government can just print more and more and more. Bitcoin is strictly limited to 21 million Bitcoin. That's the maximum. You also have privacy, which people like because it doesn't go through banks. So the banking system's not involved. It's the blockchain, which is a decentralized computer network, which keeps track of all the transactions. So you have limited issuance, you have privacy, but the privacy can be a downside in that if you're a drug dealer or a human trafficker or a money launderer, well, Bitcoin is wonderful because government's out of the picture, banks are out of the picture, and that's one of the reasons why regulation could actually hurt these cryptocurrencies badly. China's already said that they're not going to allow crypto. They're going to start their own state-sponsored cryptocurrency, which I don't even want to comment on what that in the Chinese digital currency. But to call Bitcoin or any cryptocurrency, including Ethereum and Litecoin and these others, an inflation hedge, I mean, the fluctuations in Bitcoin already have just been pretty absurd. I mean, we saw this huge run up, then we saw a big retracement, and now, of course, we've seen it go up tenfold just in the last, I don't know how many months it's been. But it becomes something of a speculative mania because Bitcoin doesn't have any intrinsic value. It's not easy to make transactions with it. Even mining Bitcoin takes up a tremendous amount of energy. And there's also the possibility that regulators will look at what Bitcoin's being used for and clamp down on it. But people are attracted to momentum. Anything that's going up and up and up and up and up, people start saying, I wish I had some of that. And so they want to get in on the action. And I just think that while obviously there's some companies like Tesla and Mass Mutual and others that have said they were going to accept Bitcoin, Starbucks even, it's a long ways from widespread acceptance. And so I would call cryptocurrencies, including Bitcoin, nothing but a speculative trading vehicle at this point. To say it's an inflation hedge, just to back up for a second, Michael, I don't know if you're aware of this or not, but gold was as much as $850 an ounce in 1980. And here we are more than 40 years later, and gold is not worth even twice as much as it was then. It has not kept up with inflation, and that's the inflation hedge, gold. I mean, Bitcoin could be worth a small, it could be worth a lot more in the short term. Obviously, it's a speculative. I think it's a speculative mania, and you can't make a reasonable projection about when the irrational behavior will end if it's a speculative mania. Um, but I just think that to call Bitcoin anything other than a speculative trading vehicle at this point is no one needs to own Bitcoin or Ethereum or Litecoin or any of the cryptocurrencies. But if you want to trade them for fun, I would keep it small and realize that there's significant downside risk to cryptocurrency.
You have this chart in your book showing an investment of a dollar in different assets in 1801 all the way up to the present, and a gold would get you $100. So that may sound good, a 100-fold increase in 200 and something years, but in fact, let me just read this correctly here. Stocks would give you $100 million, or no, about $50 million, $60 million from that dollar. So gold is just nothing compared to what just an index fund or just the most secure, safe, risk-free stock and bond or index or mutual fund could get you in the long run.
Right. I look at it this way, Michael. Imagine you ran into a kid who just graduated from college, and he says, "Michael, I'm thinking about where to put my savings, and here are my choices. I could put the money in the bank, I could loan it out at interest, I could put it in gold, or I could own a profitable, thriving business. What should I do with my money?" Well, almost anybody would say, "Well, gosh, if you can own a piece of a profitable, thriving business, that would be better." Well, putting money in the bank is cash. Loaning it out in interest is bonds. Gold, of course, is gold. And owning a profitable business is owning common shares of stock. Common stock means you have a fractional interest in an ongoing business, and you get to share in the appreciation and the dividends of that company. And your return, if you own a share of Microsoft, your return on that investment is going to be exactly the same as Bill Gates. You and Amazon will be exactly the same as Jeff Bezos. People talk about inequality. You're going to be treated just like Warren Buffett if you own shares of Berkshire Hathaway. So the idea is if you have a diversified portfolio of great businesses, most of us don't have the time or the money or the expertise to found and run our own companies. But anybody with even a modest amount of money can own a selection of the best companies in the United States and around the world and enjoy the returns of a business owner. And you don't have to even show up for work. It's no hiring and firing employees or dealing with lawyers and accountants or managing employees. You get the returns from being a shareholder. And I should also point out at this point that we're in a golden age for investors right now, because it used to be that the people thought, oh, the little guy doesn't stand a chance. But right now, most of the discount brokerages have no account minimum. You can start with any amount, so nobody's has an amount too small to get started. Commissions have come down to zero in most discount brokerage firms. You've got more choices. You can trade electronically at lightning speed. You can monitor your investments in real time if you want. And there's more choices available: stocks, funds, ETFs. This is a wonderful time to be an investor, but people have to understand why we have markets and how to use them to reach a level of financial independence that gives them the ability to live their life the way they choose.
All right, let's say I got $1,000. I can buy Apple. Let's see. So it's a 134.72. Let's say I take my $1,000, 1,000 divided by 134. So I can buy 7.4 shares of Apple. Now, that's not going to net me much over the coming months or years, and it kind of goes up and down, and I'm watching it carefully. But I can take $1,000 and put it in a mutual fund or an index fund, and I get a tiny little piece of all 500 Fortune 500 companies or S&P 500 or whatever. So just kind of what's the difference between an index fund and a mutual fund?
Okay, well, so first of all, there's a mutual fund and an ETF. I'll explain that. And then there's an actively managed fund versus an index fund. So a mutual fund is simply a vehicle for holding a diversified portfolio of securities. It's got professional management. It's got daily liquidity. As you said, you can put whatever amount you want, put $100, $1,000, $100,000, plunk it into the mutual fund, and they will calculate the net asset value, which is the value of the securities in that portfolio at the close of each business day. And if it's up, your investment's worth a little more, and if it's down, it's worth a little less. We know that over the last 200 plus years, you cited the graph there by Jeremy Siegel, the Wharton School of Business, that since 1802, U.S. stocks have gone up at an average rate of about 10% a year. So if you have a U.S. large cap index fund, it's going to go up about 10% a year on average. Some years will go up much more than that. Some years will go up less. Some years it'll go down. That's just the nature of the market. So an index fund owns an index like the S&P 500, which is large cap stocks, or the Russell 2000, which is small cap stocks, or the Morgan Stanley Capital International Index, which is international stocks. So you can own it through a mutual fund, which is bought and redeemed at the closing price each day, or you can own an exchange traded fund, or ETF for short. And that, in that case, it's an index that trades on an exchange like a stock. The price is going up and down from 9:30 in the morning to 4 o'clock at night. You can trade it intraday if you'd like, instead of waiting to the end of the day for the closing price. And they both have very low expenses, both ETFs and index funds. And they both have great tax efficiency because if an index fund doesn't change the portfolio around, the problem with actively managed funds, well, there's a few problems. The first is that most active managers don't beat their benchmark. And when I say benchmark, if you're a large cap, I don't want to use terminology your viewers don't know, but a large cap is a large company like an Apple or an Amazon or Microsoft or an IBM. Large cap managers try to beat the large cap index like the S&P 500. A small cap, which is managing small companies with a capitalization of say $2 billion or less, they're trying to beat the small cap index, which is the Russell 2000. And if you do better, then you're outperforming the index. And if you do worse, you're underperforming the index. And as I pointed out earlier, the vast majority, 3/4 approximately, of all active equity managers fail to beat their benchmark every year. And over longer periods of time, over 9 out of 10 of them do, and not by a little bit, by about 400 basis points a year, 4 full percentage points a year. And so one of the points that I make in this book is if you buy just an index fund, which may sound boring, but trust me, if your money is compounding at 10% a year, as the S&P 500 is given now for decades and decades and decades, it's still doubling approximately every 7 years, quadrupling in 14 years, eightfold in 28 years, and so on. And that's why the biographer of Warren Buffett called his book on Buffett the snowball, because what seems like a small amount in the beginning snowballs and gets bigger and bigger and bigger. You have a substantial sum as the years turn into decades, and you get to reach retirement. Then that small sum, especially if you're investing regularly, turns into a quite substantial sum.
There's that quote from Einstein that's famous about way more powerful than the laws of gravity or physics or whatever it was is compound interest. How these things just build.
He called it the most powerful. Compounding is the most powerful force in the universe. He said.
Yeah.
Einstein.
Yeah. So just give some numbers here from your book. Let's see. For example, Green calculates that if you invested $10,000 in 1990 in a mutual fund tied to the entire S&P 500 and then went fishing, or in my case, cycling, 20 years later, you'd have $90,000, not counting dividend reinvestment, which would push you well over a $100,000 figure. By contrast, if you tried to be actively involved in trading, buying and selling stocks and trying to anticipate what the market would do, you risk missing the biggest increases in that 20-year block. For example, if you miss just the 5 best days in that 20 years, your $90,000 account would be plummeted to $45,000. If you miss the 10 best days, you'd end up with around $35,000 from your initial $10,000 investment. If you missed the best 25 days of your $10,000 investment, you'd only have $19,000. And if you missed the best 50 days, you'd actually lose money. And then continuing with your calculations here, the decade from 2005 to 2015, which includes the Great Recession in 2008, 2009, that wiped out so many people's investments. If you had invested $10,000 in the S&P 500 with dividends reinvested, you'd still be left with $36,400. Astonishing. And again, had you bought and sold stocks and missed the market's 10 best days, your $36,400 would have been cut to half at $18,300. So this is the problem with anybody that says, well, I can beat the market. No, you can't. Only retrospectively, with the hindsight bias, you can take the 6,000 mutual fund traders or however hedge fund trade, whatever they're called, that are in the market, and after the fact, you can pick out the dozen that beat the S&P 500 10 years in a row or whatever.
Right. Well, actually, I know from our prior conversations, Michael, that you have beaten the market in the way that I have also beaten the market, and that is you do it with a security selection, not jumping in and out of the market. People there's a great temptation to look at all those peaks and all those valleys and just say, wow, if I was just in for the upswings and then out for the downturns and then in for the next upswing, And that's called market timing. And when you look backwards, you can see exactly where you should have been in and exactly where you should have been out. And maybe you tell yourself, I know I won't time it perfectly, but if I'm just in for most of the upturn and out for most of the downturn, it's a total pipe dream, because when you look forward, there's only that blank slate. And so the idea behind those examples I gave in the book is, if you think you're going to get out and then get back in at a time when the outlook is better, which means the market's probably already discounted that and stocks have gone even higher, the chances are you're going to miss some of the very best days. And the other problem is, if you get out of the market and the stock market takes off, well, now not only have you missed the upswing, and if you stay out, may miss more of the rally, but having missed the rally, if you now get in, you could be in for the correction. So you would have missed the rally and be in for the correction. So it's like committing Harry Carey to be jumping in and out of the market. And yet people are tempted. Oftentimes they don't even know they're market timers. They say, well, I know I can't time the peaks and valleys, but take March of last year, they're saying, this pandemic's really scary, so I'm going to just move to the sidelines and I'll get back in later when things look a little better. And of course, the market is a forward-looking mechanism, and stocks start heading higher, not when things start looking better, but when things looked awful. But people were looking ahead 6-9 months out, are saying like, wow, the pandemic is terrible, but it's temporary, and things are going to eventually get back to normal. We are going to have vaccines, we are going to have herd immunity, and we are going to have a return to normality. And to think that that's all going to happen before the stock market discounts it is wishful thinking. It's going to happen ahead of time. So the idea behind this book is, it's not timing the market, it's time in the market that leads to good returns. And most people should set up a portfolio and leave it alone, except for once a year they should rebalance it to bring it back to their original asset allocation, which I can talk more about if you like. But the idea is to stay in the market, realize there are going to be inevitable downturns. No one's going to ring a bell at the top of the market and say, okay, now you can get in, get out, and then ring it at the bottom again and try to get back in. That just doesn't happen. And amateurs who think they can do it are going to learn the hard way that it just can't be done. You can beat the market. Buffett's done it. You've done it with some of your great technology investments in the past. I've done it with some of my stock selections. But you beat the market by buying uncommonly good companies, not by jumping in and out of the market. No, nobody does that. John Bogle famously said, there are only two kinds of market timers. Bogle, of course, being the founder of Vanguard. He said, the two types of market timers are those who don't know what they're doing and those who don't know they don't know what they're doing. That's the only two types of market timers out there.
That's really funny.
So it's time in the market that makes the big difference.
Yeah. Yeah. So it's really a long-term statistical average. That 10%, by the way, includes the Great Depression, the Great Recession of our century, and all the other, like the 1987 collapse and all the other ups and downs, major downs. So 10% is actually pretty good.
Right. That's the average annual return. And I should also point out that while the market does not go up every year, over in 5-year period, you can start at any point you want, any peak in the market. 5 years out, more than 2/3 of the time the market gives a positive return. Over 10 years, 88% of the time it gives a positive return. And over a 20-year period, 100% of the time, U.S. stocks have given a positive return. So there's never been a 20-year period of negative returns for U.S. stocks. So if you can truly think long-term and act long-term, the odds are truly on your side.
Yeah, one of my other favorite stories comes from Leonard Mlodinow's book, The Drunkard's Walk, How Randomness Rules Our Lives. So he highlights fund manager Bill Miller, who I know you know, who in 2006 was declared by CNN Money as the greatest money manager of our time because he beat the S&P 500 stock index 15 years in a row. So Leonard actually did the calculation with 6,000 fund managers in the U.S., and he did a simple coin flip calculation that the odds that someone in that cohort of 6,000 fund managers would beat the S&P 500 15 years in a row turns out to be 0.75 or 3 out of 4. After the fact, you pick out, well, that's the guy that did it. But before the fact, you have to, project outward. Okay, for the next 15 years, which of the 6,000 is going to, nobody knows. So as Len put it, that CNN Money headline should have read, expected 15-year run finally occurs. Bill Miller, lucky beneficiary. And then, wouldn't you know it, in the 2 years after Miller's 15-year streak, the story read, the market handily pulverized him. I think that actually comes from your book. And
Yeah.
so this is
Yeah.
called. Yeah, go ahead.
Poor Bill Miller. Just it seems like Bill Miller is a brilliant guy. He's still out there managing money. But right after that 15-year streak came the Great Recession, and he loaded up on all things banks and builders and mortgage companies and just all those people who piled in because he had a 15-year great track record. Then he had a severe period of underperformance and actually lost his position at the Legg Mason Value Trust where he developed that great track record.
Interesting. I
So
didn't
yeah,
know
you
that.
just can't judge that boilerplate that past performance is no guarantee of future results. It really means.
Yeah, the other statistical concept I like in this field is the survivor bias. So here's how the Pomona College statistician / economist Gary Smith analyzed two of the best sellers in the genre of these business books. In the 2001 book, Good to Great, which sold over 4 million copies, the author Jim Collins culled 11 companies out of 1,435 companies whose stock beat the market average over a 40-year time span. And then he searched for the shared characteristics among them that he believed accounted for the success. This is the hindsight bias. Instead, said Smith, he should have started with a list of companies at the beginning of the test period. The next step would be to use plausible criteria to select 11 companies predicted to do better than the rest. These criteria must be applied in an objective way without peeking at how the companies did over the next 40 years. It's not fair or meaningful to predict which companies will do well after looking at which companies did well. Those are not predictions, they're just history. In fact, Smith notes from 2001 to 2012, the stock of 6 of Collins' 11 great companies did worse than the overall stock market. This implies that this system of post hoc analysis is fundamentally flawed. He found a similar effect in the 1982 book In Search of Excellence, over 3 million copies sold, in which Tom Peters and Robert Waterman identified 8 common attributes of 43 excellent companies. Since then, says Smith, out of the 35 companies with publicly traded stocks, 20 did worse than the market average. So therein lies the problem of prediction and post-diction.
Right, right, right. And that survivorship bias is also true in the mutual fund industry. What Wall Street firms have learned is obviously if a mutual fund has a bad patch, it's no longer marketable. And so what they do is they just close the fund down. Of course, they don't want to actually return the assets to the investors. They'd rather keep those assets earning management fees for the companies. They generally will fold the underperforming fund into a different fund, and so therefore that fund with its poor track record vanishes. So when you're looking at the list of you go through the mutual fund pages and you look at the Merrill Lynch funds and the Morgan Stanley funds and the Goldman Sachs funds, those are the survivors. Those are the ones with the best track records. And again, most of them haven't beaten an unmanaged benchmark. It's just not widely recognized. It is more widely recognized. When my first edition of the Gone Fishing portfolio came out in 2008, indexing was pretty rare. The vast majority of money actively managed funds, but people have caught on. Even Larry Fink, the head of BlackRock, said in his letter to shareholders last year that people are catching on that it's portfolio construction, not security selection, that drives investment returns. So, um, so that's the key: is putting together a portfolio that's designed to do well in good times and bad. To not only makes money in the good times, but conserves money in the tough ones.
And now back to that IRA, SEP. Let's see. There's an IRA, SEP IRA, Roth IRA, 401k. Where should I put my money?
Well, what everybody should do for starters is if you have a 401k where your employer will provide matching, that is free money. If your employer will do, for instance, 25% matching, you can put it into a fund that earns nothing this year, but you're still going to get 25% because your employer is going to kick in 25% of your contribution. So you do that for a couple of reasons. One, it's pre-tax, so you're going to save money in taxes. Two, that money is going to compound tax deferred because a 401k is a qualified retirement account. And then, of course, you have employer matching often does. But even if there is no employer matching, or if the employer has a tough year and isn't able to match 1 year, it's still the smart way to invest is pre-tax in a tax deferred account. Beyond that, maybe you don't qualify for a 401k, or you can put money into an IRA in addition to your 401k. The difference between a SEP IRA and a regular IRA is a Roth IRA SEP IRAs for self-employed people, SEP. A Roth IRA, the contributions that go into that are not tax deductible, but the money you take out after compounding tax deferred, there's no taxes on it. When you take your money out of a 401k or an IRA, that's a taxable event down the road. So the government's going to get their share later on in the 401k or the IRA. But with a Roth, which is a special kind of IRA for which affluent people don't qualify, then you get to, or I shouldn't say affluent people, but high income people don't qualify for a Roth. That money compounds tax deferred, and the money comes out as tax free. That's another smart way to save.
So the idea is that when I'm retired, I will be making less money, so my tax rate will be lower. And then when I take the money out of that account and I'm paying now the lower tax rate, that's the hedge against paying higher taxes when I'm younger.
Right. There's three benefits. Is one, the contribution you make to the 401k or the IRA is tax deductible this year. Secondly, it's going to compound over the years tax deferred, whereas the investments outside of your qualified retirement account, you're going to pay taxes on all those dividends and capital gains and interest payments. And then, of course, as you mentioned, you would hope, we can't predict tax policy in advance, but you would hope that when you retire and you have less earned income, you're going to have a lower tax rate. So when you start taking money out of those retirement accounts, it would be taxed at a lower rate than it would be now. So those are the advantages of tax deferred investing.
What about Social Security? I mean, we're all paying into it whether we want to or not, and so
Right.
I'm going to get my money, and since I turned 65, I get the letter from the Social Security saying, "Here's what you're going to make," and but if you wait, till you're 70, you'll make this much more, and I'm like, okay. So I did the calculation, and it's like a gamble against the government on when I'm going to die. So I'm thinking, okay,
Right.
I'm
Yes.
going to live longer just so I can get more money from these bastards who took my money. No, I'm just kidding.
Well,
But
you
what do you?
probably are going to live, go ahead.
Well, so what do you? Yeah, I might, but maybe I'll get run over by a truck on my bike. So you never know. But let's just say the average person think, okay, I'm going to retire at 65. Should I start collecting at 66? Should I wait till I'm 70? What do you recommend people do on that?
Well, if you're in good health, you're better off deferring because the government's going to give you more if you wait as long as you can to take your Social Security contributions. People who are in poor health don't think they're going to live that long, or obviously are in financial straits and they need the money now. They simply can't defer the Social Security. But as I point out, Michael, you're a cyclist. You're in good shape. You're not obese. You probably don't have any pre-existing conditions, any serious medical conditions. So if someone was in poor health or obese or had genetically have their family doesn't have a long history of living a long time, heart disease or what have you, they might want to go ahead and take the money sooner and enjoy it while they can. But someone who's able to defer taking the Social Security is better off putting it off because you will get more, larger payments by deferring it as long as you can.
And occasionally you hear, well, Social Security is going to go bankrupt by 2030, 2040. I've been hearing this since I was in my 20s, and my sense is that the government will never let that happen. They'll just print more money, whatever they got to do. But is there any chance that could happen? It just fold up and the government says sorry.
I think that you're right. That it's been said that Social Security is the third rail of politics. You touch it, you die. That it's such a popular social welfare program, and people have counted on it. Sometimes devoted their have not saved as they should and invested because they were counting on that Social Security. So I think it would be political suicide for either party to say that sorry, the money's not there. We all know that the government can create money and run deficits, which they've done in spades in recent years. And so even though there's these various projections as to when the Social Security Trust Fund will run out of money, whether anyone would actually not receive Social Security is actually fixing Social Security is one of the few government problems. It's just a math problem. What you have to do is either raise the age of eligibility to receive it, or raise the taxes on Social Security, or change the terms of what you're going to get. That you can modify the system. It's much harder to fix the healthcare, the Medicare problem because health is very expensive. And there's a bigger gap there, but the unfunded liabilities for both Social Security and and Medicare and Medicaid are huge. But I don't think it's likely that Democrats and Republicans who will ever say, sorry, the money's just not there, because who's gonna reelect those incumbents if they can't get the Social Security they've been counting on for decades.
Yeah, and people used to say, well, the government can't just print checks and send them out to everybody. Well, apparently they can, because they just did twice in the last 12 months. So, but of course, the question is always, well, is this going to lead to hyperinflation like it did in the 30s and so on, or 20s in Germany and whatnot, or another Great Depression? And now I've been reading about this modern monetary theory, which I haven't read the books on it yet. But as I understand it, as long as the economy keeps growing 2, 3, 4% a year, the government can just keep printing money, running up debt, and paying for it down the road because the economy is growing. What are your thoughts on that in the context of these bigger issues like Social Security, or even something like a universal basic income?
All right. Well, let's start with modern monetary theory, MMT, as they call it. The basic premise there is, if you're a sovereign nation like the United States and you can print money in your own currency, technically you can never go bankrupt, because you can just print the money to pay the interest on your debt and issue more debt and print the money to pay the interest on that. Um, that much is true. That much is true. But what the modern monetary theorists don't seem to realize is that there can be incredibly negative repercussions, as we saw in the Weimar Republic with hyperinflation, and with Argentina, and with Zimbabwe, and other places have had terrible bouts of inflation because they simply couldn't. When there's Milton Friedman famously said that inflation is everywhere and always a monetary phenomenon, too much money chasing too few goods and services. So if you just kept creating all this debt like it's monopoly money, the problem is it's going to make the money you have worth less and less and less because of inflation. So there are serious economic repercussions, and even people that I disagree with, like Paul Krugman, who's a big gung-ho deficit spender, says modern monetary theory just doesn't make any sense. I wish it were true, because if it didn't matter how much debt they ran up, they wouldn't need to collect any taxes from me and you, Michael. I mean, after all, if you can run up as much debt as you want, it doesn't matter. Why collect taxes? So modern monetary theory, the government is really taking a risk, and no one knows exactly how this is going to play out. Someone I think knows as much about how Washington works as anybody is George Will, and I had dinner with him a year or so ago, and I asked him. I said, George, how is this going to play out? And he just threw his hands up. Nobody really knows how this is going to play out. But I think it is important to realize. So why have we been able to run up so much debt so far without inflation? There've been a couple of really deflationary things happening. One, of course, is globalization. That has kept costs down. Another is technology and automation, which has kept wages down, and women entering the workforce. Obviously, that's the more workers you have, the less scarcity of labor there is. So there are reasons, and of course, interest rates have come down during the Great Recession and stayed this. Who would have thought 10, 12 years ago that interest rates would still be scraping near zero this far after the 2008? And so the interest we're paying on the debt now, even though it's more than tripled in size, is not that much more than we were paying 12 years ago, because interest rates are so much lower. So one of the real threats is when interest rates normalize, which they will eventually, even if the Fed holds rates lower and they stay down for a few more years. If rates normalize, the government's got to start paying interest on all this debt that they've accumulated, they've created during these last few years. And to think that you can just keep doing this, I mean, there seems to be a mindset out there is like, well, we've run up all this debt so far, and there's not been any terrible ramifications, so we can just keep doing what we're doing. And I think a lot of politicians would like that to be true, because they want to create the spending to give constituents what they want. They don't want to make them unhappy by charging them the taxes to pay for it. But it's really kind of a sad thing, because it's all that debt is going to affect future generations, and they don't have the right, they don't have the ability to vote on this. The children and the unborn can't vote on the interest rates they're going to have to pay and the slow growth they're going to have because of all this debt we've run up. So I think it is a potential risk. And we're fortunate that we've been able to have this much prosperity for this long, despite the debt. In fact, there's no doubt that all this government money, even right now, you see it coursing into the economy. People are ready for a boom this year. It's going to be unlike anything we've seen since the 1950s. Goldman Sachs and Morgan Stanley and JP Morgan are all forecasting approximately 8% GDP growth. That's something that was unthinkable a couple of years ago, but it's due to ultra low interest rates and all this free government money and all this deficit spending, stimulus cash and so on. And it's great. It's like a party. It's everything's going great, but there's always the possibility of a hangover down the road. So we have to see how this is going to play out.
So just as a point on how this works, the Fed says, all right, we're going to keep the interest rates as close to zero as we can. But what if the banks go, well, we just can't cut it. We're not making enough money. We're going to raise our interest rates. Can they do that? Does the Fed have control over that? How does that work?
Well, the Fed controls short-term rates. The market generally sets longer-term rates, but lately, as you know from quantitative easing, the Fed's buying up bonds to suppress longer-term rates too. But the Fed sets the rate that banks borrow from the Fed, and then they can loan out at a higher rate of interest, and they earn the spread. Um, so yeah, the Fed can keep rates low as long as they want to. They're not going to keep them low if inflation becomes a problem. You'll hear Jerome Powell when he speaks always say that if inflation, they're willing to let it run above their target of 2% or a little bit. But obviously, if we had hyperinflation like we had in the late 70s and early 80s, then rates are going to go up. It's hard to believe, Michael, but back in 1982, government bonds yielded over 16%, and from there, interest rates have come straight down. So for 40 years almost, we've had declining interest rates, and I think it's going to surprise a lot of people what happens when interest rates turn and go back up, because obviously it makes it more expensive for consumers and businesses to borrow, but also for governments to borrow. And also higher interest rates provide competition for stocks, because right now, if you're not in the stock market, you're earning next to nothing in bonds, or practically nothing itself in the bank. The average bank account pays 0.05% interest, which means that if you reinvest that interest year after year, Michael, that your money will double in just 41,000 years.
Right.
So it's not easy to get rich putting your money in the bank. So, and that's one of the reasons why I make the point again in the book that equities, common stocks, diversified portfolio of stocks is the best way to save and reach I shouldn't say save, but to take your savings and put them to work to reach your most important financial goals.
Yeah. Well, let's talk about that. Why should I want to, why do I want money? What good is money? Money can't buy me happiness. Why should I care about that?
Yeah. Well, people often say that money can't buy friendship or true love, and the best things in life are free. And there's a lot of truth in that, but it's not the whole story, because life's expensive. And having money means that you can live where you want, do what you want, with whom you want. Money gives you freedom, it gives you security, it gives you peace of mind, and it allows you to help people that need help, donate to worthy causes. So it actually lets you have choices, lets you take control of your life. And so I think everybody wants to have a certain level of financial freedom and not be dependent on the government or someone else for their well-being. So the important thing to realize is the principles of wealth creation are well understood, but most people don't understand them. And there's a guy by the name of Dr. Stanley, I think his name was, who wrote The Millionaire Next Door about 20
Yeah, I was going to ask you
years
about
ago.
that.
Yeah, and he what he did is he studied people who had a net worth of $1 million or more. And I don't know if you know this, Michael, but according to Spectrum Group, 1 out of every 8 households in the U.S. has a net worth of $1 million or more, and that's not even including home equity. If you include home equity, it's an even greater number. And at the same time, approximately 40% of households couldn't find $400 in an emergency. So why is that? Well, I mean, we can feel nothing but sympathy for the people who just don't have the mental or physical capabilities to earn much more than a subsistence living, and I fully support social welfare programs for those people. But that doesn't describe the vast majority of Americans who are doing something terribly wrong. And what Dr. Thomas Stanley discovered was that the people who are affluent, it's not that they founded a really successful business, a computer company in their garage, or played third base for the Yankees, or had a million selling record. What they did is they maximized their incomes by through education or developing marketable skills. They lived beneath their means and religiously saved the difference. And they educated themselves on investment opportunities, and they took those savings and they put them to work, and they compounded that money over a period of years or decades, and they became millionaires. And they did it. That's the overwhelming answer for why so many. I mean, I think one out of every eight households having a net worth of $1 million is a pretty astonishing fact. But I think the rest of us need to understand, what are these people doing? They're not just lucky. I mean, they could be lucky that they were born with a higher than average IQ, or to a great family, or had great educational opportunities that other people didn't. That certainly could be a factor. But what they have done is work, save, invest, and compound over a long period of time. And so to answer your question, why do we want money? We want to have money so we can live the life of our dreams. And what do? I always say, if you're retired and you don't have enough to live comfortably, here's what's happened. Either you didn't work, or you worked and you didn't save, or you saved but you didn't invest, or you invested but you didn't do it successfully, or you invested successfully but you couldn't keep your hands off the money. You had to spend it on the new boat, the trip to Disney or Europe or whatever. That's what you have to do: work, save, invest, compound, and then keep your hands off the money and let it keep compounding. You can save separately for vacations and boats and whatever, remodeling the kitchen, whatever you want to do, but you should segregate. This is my retirement account. That's the beautiful thing about a 401k or an IRA, a Roth, what have you. That's set aside for retirement, that you can save separately for the down payment for the house, for the new boat, for the trip, whatever. But that's how affluent people become that way. They follow proven principles of wealth creation.
I didn't know Disneyland had gotten that expensive, equivalent of a boat. Okay.
All right. Well, you're staying at the suite at the very top.
That's right. Yeah. So here, just to put a enumerated list on it from your book, from the millionaire next door, they live well beneath their means. 2, they allocate their time, energy, and money efficiently in ways conducive to building wealth. 3, they believe that financial independence is more important than displaying high social status. 4, their parents did not provide economic outpatient care. 5, their children are economically self-sufficient. 6, they're proficient at targeting market opportunities. And 7, they chose the right occupation. So, I've given this a lot of thought over my life. I think I agree with you completely on that. It's the autonomy. It's the freedom. It's not the money really that matters to me as much as also the freedom from having to think about it. In my 20s and 30s, I was a bike racer, and then I was a part-time college professor and this and that, and just trying to start writing books and so on. And just constantly thinking about it every month. It's like, okay, I got these bills. And it consumed like half my, brain energy to just figure out how I'm going to do this. And so for me, the whole goal to make more money was not, so I can have a nicer bicycle or whatever. At the time, I was getting those for free, so no problem. But really, just so I don't have to think about it, so I can think about like my next book. I can think about that problem I'm working on rather than how am I going to make my mortgage. And so one goal for me of making more money, and 2, living below my means, but beneath. Right? Am I saying that right? Beneath my budget is just so I don't have to think about it. And there's
right. That's one of the beautiful things about money. It frees you from the task of having to think about it, because if you're constantly one step ahead of your creditors or your bills, or wondering how you're going to make it happen, you're right. It sucks your time, your energy, your positivity away, and the idea behind accumulating a 7 or even 8-figure net worth is not that you can have so much more stuff. I mean, yeah, that often comes with it if you're highly affluent. But the best part about having money is having the freedom to A, not think about money, and B, live your life the way you dreamed about living it. That you just simply can't do that if money is an oppressive worry all the time. And the important thing for people to learn, and this is why it's a shame that basic financial literacy isn't taught. People graduate from high school, they don't understand. If you make $40,000 a year, you got to spend $35,000 a year less. You just can't spend every bit of it and max out your credit cards and make the minimum payment and think that you're not going to be in bad shape 10, 20, 30 years down the road, because that's what a lot of people are doing, and they're regretting it. They're looking back. I point out in my book that if you invested less than $230 a month and you earned nothing more than the 10% average annual return of the S&P 500 since its inception, then you would become, and you put it in a Roth IRA, you would have in just over 30 years $1 million tax-free, and we're talking $230 a month. I know that not everybody can do that, but a whole lot of Americans can do that, and it's the difference between enjoying your retirement and counting it, spending it counting nickels and dimes. It couldn't be more stark.
Yeah, when I was in middle school and high school, there was the closest thing to that was home economics, whatever that was. But it wasn't this, it was, and also just basically, how does the stock market work? How does an economy run? Just really basic stuff like that, along with statistical literacy and research methodologies. Just how do we know what's true? How do you determine causality in anything? How to think critically, and so on. Everybody says, well, we teach critical thinking, but they don't really. So just instead of, I know algebra, pre-calculus, calculus, I did all those. But I don't use any of that. What I really could have used was, your book, basically, how does all this work? What does it even mean to own 10 shares of Apple computers? What could that possibly mean? And why would it go up? What makes it go up? I don't know.
Right. Well, let's talk about that a little bit, Michael, because I think most kids graduate from college, and if you said, why do we have a stock market? You probably wouldn't get a coherent answer, because people didn't think, oh, it's where rich people gamble and speculate or whatever. The reason we have a stock market is this is how you put companies that need money together with people that have money to invest. Companies need money to finance their operations, to grow, to expand, research and development, buying new offices, hiring new employees, and people who have deferred gratification by saving want to earn a higher rate of return. They can invest in those companies. And when you own a share of a business, again, you have a fractional interest in that business. If the business does really well, as the old saying goes, share prices follow earnings, or the profits of the business. And if the company does poorly, like Circuit City or Borders or Montgomery Ward, Montgomery Ward was around for 100 years and went bankrupt.
Sears,
you
Sears,
just don't
Roebuck.
know. Sears, yeah, Kmart, all those companies have disappeared. So when you own a share of a business, you have a fractional control. And if you have 10,000 shares, and of course, obviously, your gain will be 10,000 times as much as somebody who has one share. But anybody can participate. And the fact that all these walls have come down, it used to be $25,000 minimum account, $150 minimum commission per trade, et cetera. That's all gone. So people really have got no excuse except for ignorance. And I mean that in the best. I'm not saying stupid. I'm talking about we're all ignorant in different ways. If someone told me to try to fix my car engine, I would be totally ignorant on what to do.
I know what you mean.
To say that I'm stupid, but people are ignorant about investment basics, and yet it's so important, because we're all going to have to deal with our income and our expenses and our cost of retirement down the road, and you gotta know what to do, and yet people don't know what to do.
Yeah, here again we have another survivor bias thing. People complain about how wealthy Jeff Bezos is now, which is entirely calculated based on the value of the stock that day. If the stock goes down 10%, he has 10% less wealth or whatever. But we're just remembering that he won. Well, he won for now, right? I mean, he ran a deficit for, 15, 20 years. He was not making money. And, if you have 10,000 employees, you got to make payroll every month or else you're out of business. Where does that money come from? Well, it comes from investors, and they are gambling on you. And when we never hear about, almost never hear about the losers. You just mentioned Sears, Roebuck, or whatever, some of these ones that have been around for a century. What we never hear about, but back to my survivor bias, and I call this the biography bias. People wanted to read the Steve Jobs biography, and this is a great book, and he's a super interesting guy. But what about all the other tech startups in the 70s? Guys that dropped out of college, moved back to their parents' house, started a company in the garage, and they went out of business. No one writes books about them. right?
No, no.
So
I remember one time you told the survivorship bias story of sailors being saved by dolphins that carried them into shore, and you said, but you don't ever hear the stories of the sailors that were carried out to sea by the dolphins.
right.
That's the survivorship bias, just the ones that
Yes,
made it to shore.
that's right. Yeah. Yeah. So, I mean, one reason that people at the top end up making a lot of money, well, they took a huge risk or they gambled, and they're the ones that happen to win. So we see them, and then we resent them or whatever, but we don't see all the people that took the risk and lost, which is probably most startups. From my venture capitalist friends, they tell me that like only 1 out of 100 companies that they invest in end up being a big payoff for the company. Where they have an IPO
Right.
and then they make their big payoff on the day it goes public and so on. Most of the time, they either go out of business or they don't do anything. They just kind of grind along, and they never get their money back, or the venture capitalists get their money back 20 years down the line or whatever. But we only hear about the ones that go get an IPO and score big, and then what did he do to earn $100 million in one day? He didn't work harder than me. It's
Right.
like, well, but it's not how it works.
Right. Well, part of it is people don't realize if you help a few people, then you can make some money. But if you help millions or billions of people, you're going to get fabulously rich. And people like Bill Gates and Jeff Bezos have touched so many people in positive ways, made them more productive, or helped fill their wants and needs. And they've done it on such a scale that they've made huge amounts of money for themselves. And I talked earlier about how people think of capitalism as greed and selfishness and exploitation, and it's such a mischaracterization if you really think about that. Because, for instance, uh, selfishness. All right, so we're all rationally self-interested, but you don't get rich by thinking about yourself. You get rich about thinking about other people. What do they want? What do they need? How can I provide it something better, something longer lasting, something cheaper? How can I make their lives better? That's how you get rich, not by thinking about yourself. Greed. You can be the greediest person in the world. Of course, it's always the other people in greedy, never us. But you just define greed as someone who thinks that there's no such thing as enough. Even if you're the greediest business person in the world, no one is going to give you a dime until you offer them a product or service of value, because all transactions in a free market economy are voluntary. So greed doesn't hold up. Selfishness doesn't hold up. Exploitation. If you don't want to work for a company, you don't have to work for them. If you don't want to buy from a company, you don't have to buy from them. If you don't want to sell to them or own their shares, you don't have to sell to them or own them shares. And if you do decide to work for a company, you have to agree. I will work these hours for this wage and these benefits. And if you don't like it, you can leave. I don't. Maybe you're not happy with your compensation, but then you can go elsewhere. So I don't really see the exploitation in that. So I think that there's a narrative about capitalism that really doesn't hold water when you think about it. And I'm not saying it's a perfect system, but as our friend John Mackey, the Whole Foods founder and CEO, always says, socialism has been tried 41 times and it has failed 41 times. People talk about Scandinavia, but those are not socialist countries. They're market economies with more robust social welfare networks. Real socialist countries like the Union of Soviet Socialist Republics or Cuba or Venezuela, they're all demonstrable failures. So capitalism is the best thing we have, the best wealth creator, the best anti-poverty program ever devised, and people should know that. And I point that out because the stock market is the quintessence of capitalism. Because what is capitalism? The private ownership of the means of production. Most of us, as I've said, don't have the money or the expertise or the time to found and run our own business, but you don't have to. You can own a piece of lots of businesses. You can own some Apple and some Amazon and some Netflix and IBM and all these companies, Coca-Cola, Procter and Gamble, and share in the profits of the business. And there's nothing stopping you. No minimum account size, no commissions. It's a beautiful thing.
And just to close the book on that subject, if we didn't have that system in place, none of those companies could get that large without the accumulating debt and investors like little guys or even the big guys buying their stock. They just wouldn't. We would never get, let's say, a MacBook Pro laptop like I have here, or my my iPhone, at a couple $100, it would be thousands of dollars or tens of thousands of dollars if it was just a little mom and pop store making them. And the only way you can do that is if you can accumulate debt through the system we have. And to be fair, I mean, you can declare bankruptcy. You can write off your investments if the company goes bankrupt and you lose your investment. Let's say you can write that off on your taxes. So, the government does try to compensate people. So it's sort of a carrot and a stick. Here's the reason you want to take these risks, because you have this big payoff and you have a system in place to help you get there. And if you lose it all, you can declare bankruptcy, or you can take it off your taxes or whatever. So the whole system is kind of balanced with that risk benefit payoff ratio.
Yeah, it's a profit and loss system. If you run a great business, you're going to profit. If you don't run a great business, or if circumstances are beyond your control and you can't run a successful business, you're going to lose your investment. And that's not just wealthy people. There are lots of the people we talked about investing in 401ks and IRAs and other invest in just ordinary mutual fund investment. They're all owning these companies themselves. They're financing Coca-Cola and Colgate Palmolive and all these companies. So it's not just wealthy people, it's little people whose combined purchasing power is greater than any of these billionaires. The benefits are widespread, not only economically as I'm a satisfied customer of Amazon, but I'm a really satisfied shareholder of Amazon and for many other companies as well.
Yeah, and of course that could all take a turn in the next few years. I'm amazed there aren't somebody like an Amazon already up there. Or maybe there is. Maybe Target or some of these other Walmart big companies that are able to capitalize and invest in online retail and delivery systems like Amazon can. They don't seem to have quite caught up to Amazon yet, but I know they're trying. So, to our viewers, Be careful. Amazon's not going to be number one forever in this business.
No. And oftentimes we can't even imagine how the disruption is going to be. For instance, who would have thought that the world's leading taxi company, Uber, didn't own any taxis, or the world's leading hotelier, Airbnb, doesn't own any real estate, or the world's leading retailer, Amazon, didn't have any physical stores for all this. So, I mean, we can't even imagine how industries can be transformed by people coming along with new technologies and new business practices.
Yeah, there was a story on the news last night about the car rental agencies. They purchased all those cars, and then during the last recession this last year, they sold most of them to stay afloat. And now there's, this summer it's going to be huge, and they're predicting there's not going to be enough cars. And they showed an ad for a rental car in Hawaii. It was like $722 a day for like a tiny little Honda Civic. Nothing.
Michael, I just came from a weekend in Austin. It was an event that I attended with 50 people, and there was lots of people stranded at the Austin airport because no rental car agency had any cars. So they were trying to Uber out to this event, and but they wanted cars for the weekend, and they just simply couldn't get them because, as you said, they sold them off during the pandemic, and now there's this resurgence of travel. They don't have the cars to rent.
So you mentioned the welfare state and a safety net. I was watching a podcast conversation with George Will and Steve Pinker. Steve's one of my best friends, and he's pretty mainstream liberal, and of course George Will is a classic longtime conservative. I think I was at that dinner with you and George Will. I think that was at Freedom Fest, and he is such an interesting guy. I'm not a conservative, but I like some of his ideas. But at any rate, they got to talking about the welfare state and how the United States, it's the percentage of GDP per year that is spent on different state programs, food stamps, Social Security, not Social Security, welfare, and so forth. And the United States is right there with everybody else. Canada, France, Germany, Great Britain, like 20% of GDP is allocated for these kind of safety net programs. I think there was some that were, close to 30%, maybe one or two below 20%. But George Will, he's like, yeah, of course we do this. It's like, whoa, can you imagine a conservative like in the 70s or 80s going, yes, we need a big welfare state worth 20% of GDP, and yet there it is. So we've all kind of shifted toward all liberal democracies, all of them. You mentioned these Northern European countries that had the kind of mixed economy. Well, they're all like that, and so maybe that's the direction we're all moving, gradually, slowly enough that even conservatives go, yes, yeah, we need that. Anyway, I just want to
Right.
get,
Well,
I want to get your general thoughts on, to what extent do we kind of have a moral obligation and even a financial obligation to help those who cannot help themselves?
yeah, I think we do have a moral obligation to help those who cannot help themselves. The problem with the entitlement state is not the poor. It's the fact it's middle class entitlements. And the tough thing in a democracy is once you create these entitlements, there's just no taking them away. I mean, who is going to stand up and say, I've been sending you this check every month for whatever reason, but now I'm going to take it away? I mean, this is why we have agricultural subsidies that were created during the Great Depression that are still exist today, and those are just a very small group of beneficiaries. When you're sending out entitlement checks to tens of millions of households in a democracy, it's very tough to get the votes to say that you're going to even reform it, much less end it, because it was the point we were talking earlier. People, if you look at the unfunded liabilities for Social Security, Medicare, and Medicaid, which is the gap between the projected cost of these programs based on the number of Americans currently alive and the projected revenues to pay for them, the shortfall is close to $150 trillion dollars, which is more than the GDP of the planet. So the question is, we've been kicking the can down the road for so long, creating entitlements and sending out checks and making sure everybody's happy, but not making anyone pay for it. And now the thought is, well, we'll just have the top 1% pay for it. I mean, if you even if the government were to confiscate the entire net worth of the Forbes 400, it wouldn't come close just to covering the trillions of dollars that the government debt has just been created in the last couple of years. Um, so again, everybody might be in favor of it, but the majority of people, vast majority of people on both the left and the right might favor all these entitlements. But the reality is you can't simply continue to run up more and more debt and never face a reckoning. If that were the case, I mean, we've seen throughout empires fall because of debt throughout history. And I mentioned the Weimar Republic in Zimbabwe and other places where people were carrying around wheelbarrows full of cash to try to meet their most basic expenses. That's the problem with running up too much debt. And so while no one wants to be the hard-hearted guy who wants to take away anybody's entitlement, and there's not so many poor people that the programs for it's not welfare and food stamps and Medicaid that are going to break us. It's the fact that the average family with driving an SUV and watching their 70-inch ultra high definition flat panel TV are also getting government benefits. That's really hard to justify when the revenues aren't there to pay for it. So again, I can't tell you, and neither can anyone else, when this is or how this is going to play out. But you simply can't create more and more debt indefinitely. We've gotten away with it so far, and so people go like, "So far, so good. Why we can just keep on doing this?" But it's never been done in the past without some kind of problem. And Hemingway had a line in one of his books where he said he asked the character, "How did you go broke?" And he goes, very suddenly," he said, "and then all at once." And that's how debt operates. It builds and builds and builds, but you reach a breaking point, and no one knows where and when that breaking point is. But if we don't do something to raise the revenue to pay for the programs, I think we do face a reckoning down the road.
Yeah, yeah, I do worry about that. As well as with UBI, have asked lots of my guests about this, and they always surprise me. First of all, I was surprised to see Charles Murray, who's famous libertarian, endorse the idea of a UBI, although he would cancel all other social programs and
Well,
replace it
right.
with that.
His is different. He wants to wrap all the current entitlements into the one. He wants to provide some sense of responsibility, and that everybody would know if that guy's on the corner, with a sign, he had got a UBI check, but he did something else with it, So if everybody's getting their check, you're at least responsible for handling what you got responsibly. So Charles Murray's idea of it's different than other people's, but I don't know how we create more entitlements like that on top of the teetering entitlement state we've already got. But there seems to be a conventional wisdom that hey, everybody thought we couldn't spend like this without paying for it, and we're getting away with it. So let's keep doing it. I've got a bad feeling about it play out long term.
And to be fair, in criticize conservatives, they have no problem running the deficit up also on military expenses, for example. Like, oh, we need a new aircraft carrier and we need to upgrade our nuclear weapon systems. Really? And
Yeah.
we
Well,
need 850 military bases around the world. We do? I
yeah.
mean, these are
Yeah.
massively expensive.
No, no, you're right. Each party has their spending priorities, and the Republicans are rhetorically conservative. They're all about balanced budgets and limited government and so on until they actually get into power. And then you have a conservative president and House and Senate. They go right on running up the deficits, same as the Democrats. So I always say we have two distinct parties in this country: the party of big government and the party of really big government. That to me describes the Republicans and the Democrats.
That's too funny. Yeah, I had Manoush Shafiq on the podcast. She wrote a book called "What We Owe Each Other." It hasn't aired yet the day we're recording this, but it comes out next week. So her program is pretty liberal. What I think most people would call pretty liberal, kind of Northern European type entitlements, and maybe even more. But I asked her about UBI. She goes, "No, I'm against it." And I think if you don't tie it to meaningful work, that is, you get a check every month. If you're not getting a check because you're doing something, going out, getting out the house and doing some meaningful work, it's not going to work. And there, she's not talking just
Right.
about economics. There, she's talking about kind of the psychology of having a meaningful life, which is wrapped up in work, along with family and other things.
Right. Yeah. Arthur Brooks, who used to be with the American Enterprise Institute, used to talk about the feeling that most correlates with success in life is a feeling of earned success. In other words, that I did something to be here. So when you give people money for doing nothing, you take away their incentive to do something, be proud of what they've created or done. I think there is some moral hazard there with just sending people money and not expecting anything in return. It's a disincentive.
Yes, it's a disincentive. Yeah. I'm also fascinated by, this larger idea of how lives turn out, genes, environment, luck, contingency, so forth. Because you mentioned this earlier. Well, if you luck out and get good genes, so you're intelligent or you have good social skills or whatever, or you just happen to pick good parents and they read to you a lot. You travel. There's a lot of books in the house. They send you to good schools and they encourage education, or maybe you go full tiger mom and your kids are up till 9 or 10 at night practicing violin along with learning Latin and two other languages and on and on, versus somebody that's born in a inner city, single mom, no dad, no money, single mom has to work two jobs, and on the story. It's terrible. And to no
Right.
fault, that they didn't choose that, and any more than the kid
No.
that chose the good parents. There's a certain amount of
No.
luck involved in life.
No, to be born to a crack addicted mother in inner city Baltimore is like starting life as a foot race in a 10-foot hole. You've got all these issues to overcome, whereas the kid who grows up, to country club parents and private schools, and they may be born with a higher IQ or what have you. There's different advantages. Although the inner city kid could have the higher IQ too, but I mean, families transmit values and mores and habits and build character. And if you're not getting that at home, that's a huge disadvantage. I mean, you mentioned George Will. He used to point out that a lot of inner city kids, they show up for preschool and they don't realize that peas are small, round, and green because no one they've grown up in a culture of silence. No one tells them just eat your peas is all they hear. And so there's a difference between how you're treated at home and how things are likely to turn. And if you've got this huge advantage starting out at school, that just compounds over time. And you're right. We should do what we can to have equality of opportunity, and then we'll have more equitable outcomes if we have give everybody the best chance of fulfilling whatever abilities and talents and ambition they have.
Well, so there where the rubber meets the road is then, well, how do you do that? Do you fund Head Start programs, or we got to have a public school system, but we know how crappy that's turned out for particularly in these poorer neighborhoods. So just keep throwing more money at it. Well, maybe that's not the solution. Maybe there's some other alternative to just throwing more money at public schools. Better teacher training, or I don't know what. I mean, now we hit the big questions, and it becomes pure politics. But what are your thoughts on how to get those people up into the chance? Well, President Johnson's famous line is, "You can't bring a man to the start line of a race, who has no training and no chance at all, and go, you're free to run."
That was No, that was his justification for the Great Society programs, and he's right. To me, Michael, the first thing is a total reform of the education system. I would prefer that all the money the federal government spends on public education goes straight to parents in the form of vouchers, and they can take those vouchers and go to any. They're not stuck in their failing inner city school. They can take that voucher and go to any school they want, and that the schools should compete for the best teachers, the best facilities, the highest graduation rates, the highest test scores. I mean, imagine if instead of the teachers unions being charged of the educational experience, that Apple and Google and companies of that caliber were trying to provide the best educational experience, and nobody could be left out because of their zip code or their neighborhood, that they could take their federal government voucher. This is what, of course, Milton Friedman was talking about this decades ago, and use that money to they get a voucher and they can go to the public school of their choice. And those, of course, they'd actually be private schools, but they could take that voucher and go to whatever school they want, and no one's left out because they happen to be born in the wrong neighborhood. I just think education reform is huge, because if people don't have the skills to compete, then you can't expect them to do well.
Yeah, let's see. The objections to that are what? Well, I know teachers unions object to this, but
that's the biggest objection.
Yeah.
But then you have to decide if the school systems are being run for the benefit of the teachers or for the students and their parents. I mean, it's when the teachers union say it's all about the kids. I mean, come on, it's all about the teachers. And listen, we need teachers. We want to be able to compensate and reward the best teachers, and we want to be able to get rid of the worst teachers. I mean, the fact that you can't get rid of a teacher if they're terrible is, I mean, what other profession can you go into where you're terrible and we still can't get rid of you? I mean, it's just not right. The union is so powerful, and they're anti-reform and, of course, anti-charter schools, which give a lot of inner city kids a chance to learn and compete on a national stage. Their grades are among the best, and it shows that it's not just that they're coming from disadvantaged families or poor neighborhoods or whatever. If they go to the right schools and they're motivated and they're taught properly, it can change. And I do think education reform is maybe it's not a voucher program, maybe it's something else, but it can't be the teachers unions in charge of the quality of education. We've seen where that's led, and every time they say we need to invest in education without reforming, the teachers unions lock on the education system, I just don't think it's going to work.
It'd be interesting to see
if it did.
Yeah, it'll be interesting to see what the long-term consequences will be of COVID-19 and the pandemic on education in the coming years. It's pretty clear you don't have to be in a brick and mortar building, at least if you're an adult or, say, college educated, maybe high school level. Below that, kids with masks at home, that's Zoom kindergarten, probably not the ideal environment. But, you can get tons of free education or close to free online. I mean, I'm fond of pointing out to people, you don't have to pay Harvard $50,000 a year. You can take Steven Pinker's psychology courses for free. He posts them online. Just follow him on Twitter. I did the same thing with my Chapman University courses. I recorded last year when Chapman shut down. I just recorded all my lectures and posted them for free for anybody to watch. And I still get letters from people going,
I'm going to watch those myself. I didn't know they were available.
It's free. It's free, right? Or you can go to the teaching company, the great courses. Those are super cheap. They used to be expensive, like hundreds of dollars, but you can now get them through audible.com, the audiobooks, for the price of one book, which is $9.95, a little over $9, not like $9.50, I think it is, for an entire college course that they record. It's amazing.
Yeah.
And then, of course, there's all the MOOCs.
I was going to say those teaching company courses are even available on Amazon Prime now. You have to pay a monthly fee, but then you can access all of them.
Oh, is that right? I didn't know that. That's fantastic. Yeah. Yes. Yeah. So I mean, I could imagine decades, maybe a century from now, where it's all done online. Education is so effective that you've kind of taken that complex equation out of the political arena and just made it available for everybody. Of course, that's what the internet was supposed to do, but now we have social media that is kind of clogging up the plumbing for with all the political divisiveness in the middle of it. But the content. I mean, on Twitter, for example, I'm on Twitter quite a bit. What I find most useful is just the links to articles, videos. I mentioned the Steven Pinker and George Will conversation. It's like, this is fantastic. And, and there's just tons of just endless content like that. That's great for free.
No, you're right. You're absolutely right. It's wonderful. Now, some kids do have a tougher time learning remotely. They need the one-on-one interaction, and I get that. But you're right. I mean, my own kids, when they got stuck in algebra or geometry, I said, let's go on Khan Academy and find out exactly how this is. I mean, here's Bill Gates. When he was the richest man in the world, he had his kids being tutored by Saul Khan for free. The same thing anybody else could do. I told my own kids that if it's good enough for Bill Gates' kid, it's good enough for you. So, and he's such a great teacher and so enthusiastic. And if you don't understand what he said, you just move the bar back and watch it again. You do some problems. If you don't get it, he explains what you did wrong, and you do some more practice. It's beautiful. I wish I could have learned math that way.
Oh, I know. I was at that TED. I think it was the 2006 TED, or maybe 2010, where Khan gave that talk about the Khan Academy, and no one had ever even heard of it. It's like, this is amazing. And then, like shortly after he was done, I saw Bill Gates talking to him. I went, okay, I know what's going to happen here. Because Gates has a portion of his foundation for education. It's like, okay, right, good. So all that's good. In the long run, those are good solutions. Well, Alex, we've been going 90 minutes. Let's kind of wrap up here. In addition to reading your book, which is a great first start, The Gone Fishing Portfolio. What do you recommend people go online? What other books should they read to kind of learn the basics of everything we've been talking about, the stock market, how the economy works, investments, and so on?
Well, when I started off in the investment industry, I went through and I read everything I could find by the best investors of all time, which this is going back 35 plus years, but it was Warren Buffett, who's the head of Berkshire Hathaway, and Peter Lynch, who's the all-time best equity fund manager, ran the Fidelity Magellan Fund, and John Templeton, who was the original pioneer of global investing and ran the Templeton Growth Funds. The idea is to learn from the people who know what they're doing, and it's not often easy to find to learn the financial basics because I often ask people, when was the last time you got investment advice that was qualified investment advice, but didn't come with somebody trying to sell you something? If someone's always trying to sell you a managed account or a mutual fund or a subscription or something, one of the reasons I wrote this particular book is to show people that you don't have to pay anybody. I mean, the Vanguard is unique in the world of investing. They are the fund family is owned by the fund shareholders. So in other words, everything is run at cost. The average mutual fund is several times as expensive as Vanguard because they're obviously a business. They're trying to make money. So there are 6 things that determine someone's future value of their portfolio: the amount of money they invest, the length of time they let it compound, their asset allocation, which is how they divide their money up among stocks and bonds and real estate and so on, their security selection, the investment costs they pay, and the taxes that they surrender to the IRS every year. So those 6 things, which are totally under your control: save as much as you can, let it compound as long as it can, use a reasonable asset allocation, choose high quality securities, minimize your costs and your taxes, and you're ahead of 95% of investors. I mean, all that's covered in my book, but there are lots. I'm sure there's Investing for Dummies books out there that have the same thing. But the key is not to commit hara-kiri by going into a discount brokerage account and just buying this and selling this willy-nilly, but to follow a proven system of investing, save regularly, compound your money over time, and that's what leads to success over time.
So if I go to like a Schwab or one of the other discount brokerage houses, and I put in $1,000, and then I type in Vanguard, it'll pop up, and I can just say buy, 100 shares of Vanguard or whatever.
If you wanted to buy the Vanguard S&P 500 fund, yeah, you could do that, or you can buy the iShares S&P 500 fund. The key is to make sure you're buying a no load or ETF that doesn't have all kinds of fees attached to it, because the brokerage community found out, oh, people are looking at the index. So they now offer index funds with all the fees in there. So Vanguard, again, all the Vanguard funds are run at cost. You can't be paying too much if you're using Vanguard. And index ETFs also have ultra low expenses, and you can buy them through any discount broker. So yes, those are two good choices: Vanguard and publicly traded ETFs.
This is fantastic. Thanks, Alex. Thanks so much for the tutorial on how to live your life at the most basic level. I mean, really, it's almost, like a public service to tell people these basics. Every kid should watch this and read your book and just get started. The sooner the better. I don't think I started really investing to my mid to late 30s, and I think, man, I wish I knew this stuff when I was in my early 20s, right, or even high school.
Right. Well, just imagine, Michael, you've shared some of your investment success with me, and it's been quite substantial. Just imagine if you had started doing that a decade earlier. I mean, 10 more years of compounding with the kind of returns you've earned, it's a huge difference.
I would call you from my private island.
Well, Michael, you can call me anytime you have an investment question. I'll be your investment concierge if you need one. Anytime you have a question.
Okay, Alex. Thanks a lot. I really appreciate it.